There is now an exchange-traded fund built entirely on the idea that artificial intelligence cannot replace certain businesses. Its pitch is railroads, machinery, and energy infrastructure. Its second largest holding is a shop that sells scented soap in shopping malls. This is LOHA, the Roundhill HALO ETF. It launched in the middle of May 2026. It trades on the CBOE exchange, and it charges 0.35% a year. HALO stands for Heavy Assets, Low Obsolescence. The thesis is simple and, honestly, quite appealing. A large language model can write your emails. It cannot pour concrete. It cannot run a freight railroad, maintain a power grid, or dig a mine. So this fund goes hunting for companies whose value is anchored in physical things that software cannot copy. It has become one of the most talked about themes of the year. While everyone else piles into chips and data centers, a growing group of investors is quietly buying everything that AI cannot touch. Here is how it is built. LOHA is passive. It tracks an index called the Akros US Heavy Assets Low Obsolescence Index. That index screens the largest American companies, throws out the bottom 30% by physical asset intensity, then ranks what is left on things like AI displacement immunity and moat durability. The survivors are cut down to 100 stocks, held in equal weight, and reshuffled every quarter. Now here is the catch, and it is a big one. Go and look at what the fund actually held at the end of June. The top 5 were Owens Corning, Bath and Body Works, Coca-Cola Consolidated, O'Reilly Automotive, and Yum Brands. Read that list again. Bath and Body Works sells candles and hand soap. Yum Brands owns Taco Bell and KFC, and it is a franchisor, which means it deliberately does not own the restaurants. That is an asset-light business model. It is close to the opposite of a heavy asset company. So how does a fund about railroads end up owning fast food and scented candles? Because the words heavy asset are doing an enormous amount of work. Once you screen a giant universe, rank it on subjective criteria, and force it into exactly 100 equally weighted names, the label starts to stretch. The story stays clean. The portfolio does not. And the fund's own prospectus quietly admits, the whole premise might be wrong. In the risk section, in plain English, it says the direction of technology is ultimately unknowable, and that companies thought to be safe from obsolescence may find their business models increasingly obsolete anyway. Performance so far? Since launching in May, LOHA is up only a few percent, roughly in line with the broad market. This is not yet a hedge that has proven anything. It is a bet that has barely started. So who is this actually for? Someone who genuinely believes the AI trade is overcrowded and who wants a value-tilted industrial heavy basket with a story attached. Just be clear that is what you are buying. A value and industrials tilt wearing an artificial intelligence costume. So tell me in the comments, is Taco Bell an AI-proof heavy asset, yes or no? I want to hear it. And if this breakdown helped, hit like and subscribe for more ETF deep dives, ticker by ticker.